CPP 2026 changes. 3 new things. Every retiree must know today. Something is shifting inside the Canada Pension Plan. Not dramatically, not suddenly, but quietly, methodically, and in ways most Canadians haven't been told about yet. If you're collecting CPP, if you're planning to apply soon, or if you're counting on that monthly payment to hold your retirement together, what I'm about to share with you could change how much you receive, when you receive it, and whether you've been making a critical mistake without even knowing it. My name is Joseph, and I've spent years analyzing Canadian pension policy, government benefit structures, and retirement income strategies. And what's happening with CPP in 2026 isn't just another small adjustment. It's 3 separate changes that will directly affect how much money ends up in your account and how secure your retirement actually is. Let's get into it. Here's what most people don't realize about the Canada Pension Plan. It doesn't just sit still. Every year, there are recalculations, contribution adjustments, policy tweaks, but most of those changes fly under the radar because they're presented as routine administrative updates. 2026 is different. We're entering a period where multiple policy shifts, some tied to CPP enhancement implementation, others connected to inflation indexing rules, and still others linked to how benefits interact with other government programs, are all converging at the same time. And the federal government has been remarkably quiet about what this actually means for individual Canadians. Pension analysts have been raising flags. Advocacy groups representing seniors have started asking pointed questions. Provincial finance ministers have noted concerns in technical briefings. But there's been no clear, unified message to retirees about what's changing and why it matters. Here's the reality. CPP is one of the most important pillars of retirement income in this country. For millions of Canadians, it represents 30%, 40%, sometimes 50% or more of their total monthly income. Any change, no matter how small it seems on paper, can have a real, measurable impact on financial security. So when I say something is shifting, I'm not being alarmist. I'm being precise. Because what's coming in 2026 involves 3 specific changes that every Canadian retiree needs to understand right now. Let's start with the first change, the accelerated phase-in of CPP enhancement contributions. Now, if you're already retired and collecting CPP, you might think this doesn't apply to you. But here's where it gets important. If you're still working while collecting CPP, and many Canadians are, this affects you directly. Here's the background. Back in 2019, the federal government began implementing what's called the CPP Enhancement. The idea was to gradually increase the replacement rate of CPP so that future retirees would get more income from the plan. Sounds good, right? But there's a cost. Higher contributions. Under the original timeline, CPP contribution rates were supposed to increase slowly, giving workers and employers time to adjust. But in 2026, we're hitting a critical threshold where contribution rates are jumping more significantly than in previous years. Specifically, the employee and employer contribution rate on earnings up to the year's maximum pensionable earnings, what's called the YMPE, will rise to 6.05% each. That's up from 5.95% in 2025. And here's the part many people miss. If you're working and already receiving CPP, you're still required to contribute. You don't get a pass just because you're collecting benefits. Let me put that in real terms. If you're earning $50,000 a year while collecting CPP, that 0.1% increase means you're paying an additional $50 per year in CPP contributions. That might not sound like much, but when you're on a fixed income, when you're managing tight budgets, when every dollar counts, that's real money. And it compounds with provincial taxes, federal taxes, and other deductions. But there's a second layer to this. The CPP enhancement also introduced something called the second earnings ceiling, a higher income threshold above the YMPE where additional contributions are required. In 2026, this second ceiling continues to rise, and the contribution rate on earnings between the YMPE and this upper limit is 4% each for employees and employers. So, if you're a higher income worker who's still employed while collecting CPP, you could be seeing contribution increases on two levels simultaneously. Now, the government's position is clear. These contributions will eventually lead to higher benefits for future retirees. But here's the uncomfortable truth. If you're already retired, or close to it, you won't see the full benefit of these higher contributions. You're paying into a system that will primarily benefit the next generation. That's not necessarily wrong from a policy standpoint, but it's something every Canadian needs to understand clearly. You're paying more now for benefits you may never fully receive. The second change involves something most Canadians have never even heard of, the post-retirement benefit, or PRB. Here's how it works. If you're working while receiving CPP, the contributions you make create what's called a post-retirement benefit. Each year you contribute, you earn a small additional monthly payment that gets added to your CPP starting the following year. In theory, this is meant to reward people who keep working and contributing after they start collecting CPP. But in 2026, the way these benefits are calculated is shifting, and it's creating confusion and concern among pension experts. Specifically, the PRB calculation is becoming more closely tied to the CPP enhancement structure. This means that the formula used to determine how much additional benefit you earn from working is changing to reflect the new, higher contribution rates and the modified benefit structure under the enhanced CPP. What does that actually mean for you? It means the amount of post-retirement benefit you earn per dollar contributed may be lower than it was under the old system, even though you're paying more in contributions. Let me say that again, because it's critical. You're paying higher CPP contributions in 2026, but the post-retirement benefit you earn from those contributions may not increase proportionally. In some cases, depending on your income level and contribution history, you could actually see a reduced return on those mandatory contributions. This is what analysts call a structural inefficiency, and it disproportionately affects older workers who are trying to supplement their retirement income by staying in the workforce. Here's a real-world example. Let's say you're 68 years old. You're collecting CPP. You're working part-time, earning $30,000 a year. You're contributing to CPP because you have to. It's not optional. Under the old system, your contributions would generate a post-retirement benefit of roughly $30 to $40 per year in additional CPP income starting the next year. Under the 2026 adjustments, tied to the CPP enhancement formula, that same contribution level might generate only $25 to $35 per year in additional benefits, even though you're paying more into the system. Now, these are approximate figures. Individual results vary based on earnings history, contribution years, and other factors. But the directional trend is what matters here. And it raises a serious question. If you're working while collecting CPP, are you actually getting fair value from the contributions you're being forced to make? The government hasn't provided clear, accessible answers to that question, and that's a problem. The third change is arguably the most consequential and the least discussed. It involves how CPP interacts with old age security and the guaranteed income supplement in the context of income testing. Here's the background. Old age security, OAS, is clawed back if your income exceeds a certain threshold. For 2025, that threshold is just over $90,000. If you earn more than that, you start losing OAS through what's called the OAS recovery tax, or clawback. And the Guaranteed Income Supplement, GIS, is income tested even more aggressively. If you're a low-income senior, GIS can provide crucial additional income, but it's reduced by 50 cents for every dollar of income you earn beyond your OAS. Now here's where CPP comes in. Any increase in your CPP, whether from the post-retirement benefit, from delayed claiming, or from indexation, counts as income for the purposes of OAS clawback and GIS reduction. So in 2026, as CPP contribution rates rise and CPP benefits adjust under the enhancement model, some retirees will see their CPP income increase slightly. That sounds good. But if you're near the OAS clawback threshold, or if you're receiving GIS, that small CPP increase could trigger a larger reduction in your other benefits. Let me give you a concrete scenario. You're 72 years old. You're receiving full OAS and a partial GIS payment. Your total income, including CPP, is just under the GIS income threshold. You're managing, but it's tight. In 2026, your CPP increases by $40 per month due to indexation and a small post-retirement benefit adjustment. That's an extra $480 per year. Great, right? But because of how GIS is calculated, that $480 increase in CPP income reduces your GIS by approximately $240 per year. So your net gain isn't $480, it's only $240. And if you're close to the OAS clawback threshold, the math gets even worse. A CPP increase could push you over the line, triggering a 15% clawback on the excess income. In some cases, you could actually lose money overall. This is called the benefit interaction trap. And it's a documented issue in Canadian retirement income policy. But it's rarely explained clearly to the people it affects most. And in 2026, with CPP changes layering on top of existing OAS and GIS rules, more Canadians are going to find themselves caught in this trap without understanding why their overall income isn't increasing the way they expected. So who exactly is affected by these three changes? First, working retirees. If you're collecting CPP and still employed, you're paying higher contribution rates and potentially earning lower post-retirement benefits relative to what you contribute. Second, near retirees. If you're planning to claim CPP in the next year or two, these changes will affect your long-term benefit structure and how your CPP interacts with other income sources. Third, low-income seniors. If you're relying on GIS, any increase in CPP, even small ones, can reduce your GIS payments and leave you with less net income than you expected. Fourth, higher income retirees near the OAS clawback threshold. If your income is hovering around $90,000 to $100,000, CPP increases in 2026 could push you into clawback territory and reduce your overall retirement income. And finally, self-employed Canadians. You're paying both the employee and employer portions of CPP contributions, so every rate increase hits you twice as hard. This isn't a small group. This is millions of Canadians navigating retirement in an environment where the rules are changing faster than the explanations. Let's talk real dollars. For a working retiree earning $40,000 per year, the 2026 CPP contribution increase means approximately $40 more per year in payroll deductions. Not catastrophic, but noticeable. For a self-employed person earning the same amount, it's $80 per year because you're paying both sides. If you're earning closer to the YMPE, let's say $68,500 in 2026, you're looking at roughly $68 more per year in contributions as an employee, or $136 if you're self-employed. Now add the post-retirement benefit adjustment. If your PRB is generating 10% to 15% less value per contribution dollar, you're effectively losing $7 to $20 per year in future retirement income for every year you keep working. And if you're on GIS, every $100 increase in CPP costs you $50 in GIS reduction. These aren't hypothetical numbers. These are the real financial pressures Canadian retirees are dealing with, and many don't even realize it's happening. So why is the government doing this? The official explanation is straightforward. The CPP enhancement is designed to ensure long-term sustainability and provide better retirement income for future generations. And from a fiscal policy perspective, that makes sense. Canada's population is aging. More people are living longer. The dependency ratio, the number of retirees compared to workers, is shifting. If CPP is going to remain viable, contributions need to increase. But there's another layer. The federal government is facing significant fiscal pressure. Deficits are high, debt servicing costs are rising, inflation has been persistent, and there's political pressure to avoid raising income taxes directly. So instead, we see incremental increases in payroll contributions, which function like a tax but aren't technically called one. From a policy standpoint, it's a quieter way to generate revenue and shore up the CPP fund without triggering the political backlash that comes with raising income taxes. Is that fair? That's for Canadians to decide. But it's important to understand the context. These changes aren't happening in a vacuum. They're part of a broader strategy to manage long-term fiscal pressures while trying to maintain political stability. Pension experts and advocacy groups have started weighing in. The Canadian Association of Retired Persons, CARP, has raised concerns about the benefit interaction trap, particularly how CPP increases can unintentionally harm low-income seniors receiving GIS. Independent economists have pointed out that the post-retirement benefit formula adjustments may not have been adequately communicated to the public, leaving working retirees in the dark about the real value of their contributions. Provincial finance officials, particularly in Alberta and Ontario, have noted that CPP contribution increases place additional strain on small businesses and self-employed workers who are already dealing with high operating costs. And on the ground, financial advisors are reporting increased confusion among clients who don't understand why their retirement income isn't growing as expected, despite CPP increases. This is a developing situation. There's no consensus yet on whether these changes represent sound policy or a misstep. But one thing is clear: Canadians deserve better communication and clearer guidance. So what can you do? First, understand your own situation. Pull your CPP statement of contributions. Review your income sources. Know where you stand relative to the OAS clawback threshold and GIS income limits. Second, if you're working while collecting CPP, calculate whether continuing to work is financially beneficial after accounting for higher contribution rates and reduced post-retirement benefit value. In some cases, it may make more sense to reduce hours or stop contributing entirely if you're over 65 and already receiving CPP. Third, if you're receiving GIS, be extremely cautious about any changes that increase your reported income. Even small CPP increases can trigger disproportionate GIS reductions. Fourth, consult with a qualified financial advisor or retirement income specialist who understands the interaction between CPP, OAS, and GIS. This isn't simple math. It's layered policy interaction that requires expertise. Fifth, stay informed. These rules will continue to evolve. What's true in 2026 may change in 2027 or 2028. You need to be proactive, not reactive. And finally, make your voice heard. If you believe these changes are unfair or poorly communicated, contact your Member of Parliament. Engage with seniors advocacy groups. Provide feedback through official government consultations. Policy is shaped by public response. Silence is taken as acceptance. Looking ahead, it's likely we'll see continued adjustments to CPP as the enhancement fully phases in over the next several years. Contribution rates will keep rising, benefit formulas will keep evolving, and the interaction between CPP, OAS, and GIS will remain a complex challenge for policymakers and retirees alike. There's also the possibility of broader pension reform. Some analysts are calling for a redesign of how income-tested benefits work to avoid punishing low-income seniors for small increases in CPP. Others are advocating for clearer, more transparent communication from the federal government about what these changes actually mean in practical terms. Whether any of that happens remains to be seen. But what's certain is this. The Canadian retirement income system is in a period of transition, and staying informed is no longer optional. It's essential. The CPP changes coming in 2026 are real. They're significant, and they will affect your retirement income, whether you're already collecting benefits or planning to in the near future. Higher contribution rates, adjusted post-retirement benefit calculations, complex interactions with OAS and GIS. These aren't small technical details. They're factors that determine how much money you have to live on. And the truth is, most Canadians won't hear about these changes until they see them reflected in their bank account. By then, it may be too late to adjust. That's why I'm sharing this with you now. You deserve to know what's happening. You deserve to understand how government policy affects your financial security. And you deserve the tools and information to make informed decisions about your retirement. If you found this breakdown helpful, please subscribe to this channel. Share this video with anyone you know who's retired, planning to retire, or concerned about their pension income. And leave a comment below. I want to hear your thoughts, your concerns, your questions. Because this conversation isn't over, it's just beginning. I'm Joseph. Stay informed, stay prepared, and I'll see you in the next one.